So once again, I would like to say good evening, everyone. We welcome all of you to our corporate tax seminar on UAE. Before we start this webinar, we would like to state that there will be a question and answer session at the end of this webinar. And should anybody have any queries with regards to corporate tax, they can post their queries in the chat box, and our speaker will then address these queries, time permitting. So let us begin our webinar today with welcome notes from our managing partner, Mr. Vasant Lad. Mr. Lad is a qualified chartered accountant with the Institute of Chartered Accountants in India and has been in Dubai for more than 40 years, spending more than 25 years in practice. Mr. Lad has experience in the field of audit, taxation, and management consultancy, and I would like all of you to give him a warm welcome.
Thank you. Thank you very much. Good afternoon, ladies and gentlemen. First of all, I must say I'm sorry that my video is not connecting. I'm not in Dubai. I'm in Mumbai right now. I hope my audio is clear enough for everybody to hear me. Thank you for joining us for this webinar on corporate tax. As you are all aware, the UAE Ministry of Finance has enacted a law on corporate tax, which is to be effective for the first financial year commencing on or after 1st June 2023. The purpose of this webinar is to provide our clients with a basic understanding of the corporate tax law, as we all are awaiting for clarifications and details on several provisions of this law, which will be announced as and when the Cabinet of the UAE decides upon those detailed provisions. Let's now begin with our webinar. Thank you. Over to you, Parimal.
Thank you, sir. To start with the webinar, I would like to introduce our speaker for today, CA Aditya Shinde. Mr. Shinde is a qualified chartered accountant from the Institute of Chartered Accountants in India, and he is also a certified public accountant from the American Institute of Chartered Public Accountants in the USA. He has spent more than 10 years of experience in taxation, be it local and international, which includes transfer pricing as well. Mr. Shinde was the chairman of the Study Circle of Tax Practitioners Association in Aurangabad, India, for 2017 and 18. He has, to date, carried out more than 20 seminars on various tax issues, be it direct and indirect. I now request Mr. Shinde to kindly address and begin the session.
Thank you, Parimal, for the sweet introduction. Good evening, everybody. So today I have covered this session, corporate tax, on 7 different aspects. The act which has come up, the decree law, is totality into 70 articles. But for any law to come into place, there are 2 parts to it. One is the act, and the other one is the law or the implementing regulations. So right now what we have is a decree law, but the rules or the implementing regulation or cabinet executive decisions are yet to be there. So based on the decree law, we'll be discussing today's topic. So to start with, see who is covered, what is covered, and at what rate. Firstly, to understand who is covered. Am I covered? Are you covered in it? If you are covered, then what part of your income is to be covered? That comes under what? And if that income is covered, what will be the tax rate of the applicable for it? So let's see who is covered. So firstly, resident persons are covered. So a resident person is a natural person. So any natural person, being an individual, if you are doing business in UAE, you are treated as a resident person, and then you will be covered under the corporate tax. Secondly, a judicial person incorporated in UAE, including free zone, is covered. It means a judicial person means maybe LLP, a partnership, LLC. These all entities which are incorporated in UAE, be it free zone, offshore, mainland, all these entities are covered. Now, entities who are incorporated outside UAE but are effectively managed in UAE are also covered. Law has also stated a provision wherein they can cover any other person who does not fall under the above definition. Now, coming to non-resident person, say you are a non-resident in UAE, but if you have a PE in UAE or you are deriving income from UAE, that is a state-sourced income, then you will be covered under the corporate tax. Now, what is a PE and what is state-sourced income? We'll see in the next slide. So, PE is as per the accepted guidelines, OECD guidelines. PE means a permanent establishment. It may be a fixed place, an office, branch, a construction site. Even if your company is outside UAE, but you have a construction site in UAE, that site or that office will be covered. Now, a dependent agent, it means you have an agent here in UAE, but that agent acts solely on your discretion, then that agent is covered as well. Next, if you have a nexus in state, nexus is a very broader term wherein the definition of nexus has not been defined yet. So we are awaiting cabinet decision for the clarification. So what do they call a nexus? However, storing, displaying, and delivering places will not be termed as PE. If you are purchasing goods from UAE, will not be termed as PE or any preparatory or auxiliary services. So this definition of PE is usually or is accepted definition as per OECD guidelines, which is there in almost all the countries wherein OECD guidelines are followed. The state source income. Say you are a non-resident entity, not incorporated in UAE, but you are receiving any income from a resident person, or you are selling goods in UAE, you are performing any service in UAE, you are receiving any rent, which is receiving any rent from an asset located in UAE, capital investment, right to use an intangible, or even interest received from a loan or a borrower who is located in UAE, including insurance. So any income which you have received under above heads and you are non-resident, you will be covered under corporate tax. Now the issues of who is covered is nexus is yet to be defined. An individual not doing business, say a person is receiving salary, will not be covered under UAE corporate tax law. So individual not doing business is not covered. However, judicial person not doing business, even a judicial person not doing business, that all income of that judicial person incorporated in UAE will be covered under corporate tax. For unincorporated partnership and family foundations, there are separate regulations which have come up, wherein you can choose whether to tax as a pass-through entity or tax for that entity as well. For family foundations, you have exemptions available whether you want to put it as a business with respect to certain conditions to it. Yes, who is covered? See, I'm covered now. Now, what part of my income is covered? So to see that, any income derived from state and outside state. When I say state, it means UAE as a country. Any income derived by a judicial person, say your company, which is LLC, LLP, or partnership, which they receive income from UAE and outside UAE, everything is covered. For a natural person, any income with respect to business in the state is only covered. For non-resident person, as discussed, any income from PE in UAE, state source income, and income from nexus in the state. Nexus being a very broader and wider term that in a future coming time we'll get to know what exactly nexus means. Now, what is covered is individual person's income apart from business. As we discussed, it is not covered. Only business income is covered. Individual receiving income from a business conducted outside the state, as per our and my understanding right now, business conducted in the state is only taxable. Business conducted outside state is not taxable or doesn't cover under the corporate tax. Judicial person's income apart from business, it is covered. Any income of that judicial person is covered. Judicial person income from business conducted outside state. If your company is having any income, even if for a business conducted outside the state, it will be covered. Now we have seen who is covered, say I'm covered, what of my income is covered, that we have seen. Now, if covered, what rate I would be taxed at? So firstly, there would be an exemption limit, basic exemption limit. So any income over and above a specific limit, that income would be subject to tax. Right now, there is no official notification or cabinet decision with regards to what is going to be the basic exemption limit. But as per public clarification documents and FTA awareness program, that limit is set to be 375,000. Now, the general rate of tax is 9%. For qualified free zone person, the rate is 0% and 9%. So we'll see what the qualified free zone person means in our coming slides. So basic exemption, as I discussed, is yet to be there, but as per the clarification or awareness program, it is 375,000. So basic exemption limit we have seen. Basic exemption for qualified income. Basic exemption limit for a free zone person who will be taxed at 0% or 5%, the basic exemption limit will be same. So it will be a core person and not core income. Now, what is a qualified income? A free zone person who is having a qualified income will be taxed at 0%. Other income other than qualified income, a free zone person will be taxed at 9%. But what is a qualified income has not been defined yet. So we are awaiting executive cabinet decision regulation to tell us what exactly is a qualified income. Now, a qualified free zone person. So even if you are a free zone person, you need to fall under a definition of qualified free zone person first. And then on the second step, you need to fall under qualified income stage. So for a qualified free zone person, there are conditions that you need to have an economic substance over there. In UAE, in free zone, you need to have an economic substance. It means you need to have employees, you need to have business, you need to have office, wherein you can establish that there is an economic substance and the company is not there just for names.
No, I'm listening.
Okay, so then transfer pricing and arm's length provision will be applicable for a free zone person's transaction with mainland and other entities. Because a free zone person being into a favorable tax bracket, all his transactions will fall under transfer pricing provisions with regards to related and connected persons. He needs to have a qualified income. And there are any other conditions the cabinet decisions may tell us that should be there. Now, as per the decree law, tax exemption is being given for 50 years, which they may extend or may not extend. And there is an election which a free zone person can make either to be taxed at 5% or 0%. Now, a question may come up that why a qualified person, a free zone person, will elect 5% over 0%. So now this will depend upon the group structure. If we form a tax group, can the losses of the free zone person be set off with against taxable income, wherein the overall group saving would be there? So the answer is not that easy. Either go directly for 0% or go directly for 5%. It will depend upon the group structure wherein if there is a benefit in going for 5% considering the losses and the set of rules, then we should elect accordingly. Now, there are also a list of exempted persons wherein they will require automatic approval or there is a process for approval. This may include government entities, public benefit entities such as schools, the list which I am not covering over here right now. Not to say all of this, everybody knows that the corporate tax is starting from the 1st June of 2023, wherein any financial year beginning after June 2023. So say your financial year is starting from January, and then it will be 1st January 2024. From that year, your income would be taxable. Now let us see how to calculate. We have seen who is taxable, what is taxable, and at what rate. Now, how do we calculate our taxable income? Firstly, we have to go as per the audited financial statements. The audit here is not compulsory as such, but the financial statements we have to cover the income. The financial statement should be prepared on accepted accounting standards. IFRS is one of that. There should be certain adjustment with regards to deferred tax as well. Now, when we arrive at our book profits as per books, we have to do adjustment on account of 7 transactions or 7 points. One is unrealized gains and losses. Unrealized gains and losses with respect to only fixed asset is covered. So any unrealized gains with regards to your non-current assets will be disregarded. Only current assets will be taken into account. Then there is this exempt income. Exempt income is not taxable, so you have to disregard it. What is exempt income? We will see in future slides. Reliefs. There are certain reliefs given by the Act, such as when a business is transferred, there is no tax on it. There is a group transfers, which is not subject to corporate tax. Non-deductible expenses are there, wherein even if you incur certain kind of expenses, these expenses will not be deducted. We'll see more detail in the coming slides. Incentives and adjustment to accounting standards, such as deferred tax would be there, depreciation rates we are expecting to come up. So these adjustment needs to be made. Transfer pricing adjustment needs to be there. We have covered transfer pricing in detail in the coming slides. So if transfer pricing adjustments are not made and the officer finds that the transactions are not as per arm's length, he can make an adjustment to our income and add back the income and put tax on it. And then there are tax losses. So how to calculate exempt income? So there are 4 types. One is dividend profit distribution from local companies. It means any income which you receive as a dividend or profit distribution from companies incorporated in UAE, that would be treated as exempt income. Then there is if you are receiving any dividend or your company is receiving any dividend, profits, or capital gains from a company which is outside UAE, that if fallen under the participation exemption criteria, then that would be treated as exempt. Then that would not be taxed. Then there is income from foreign PE. Say your company is here, you have a branch in say USA. That USA income would not be taxed in UAE. There are certain conditions to it. One of the conditions is that the branch should be taxed at higher rate than 9%. 9 or more than 9%, then that income would not be again re-taxed in UAE. And non-residents flying any aircrafts or ships in international waters, that would be exempt. Participation exemption. Whenever we receive a dividend or a profit from a foreign company, that may fall under participation exemption only if you have 5% or more holding in that company. Then the holding which you have right now should be for more than 12 months. Say you have taken a holding in that company in the previous month, you received a dividend today within 1 month. But if you hold the shares for next 12 months, then that income you should treat it as an exempt income. the branch or the other company should be taxed at 9% per month. Then the 51% of the investees should not consist of assets that would not qualify for an exemption, and other conditions which may come up in future. So if you have all these conditions, then the income which you have received from a company outside UAE, that would be tax-free or an exempt income in UAE. Just to give you an illustration, there is a further welcoming clause which has come up. Say A is taxed at 25%, which is outside UAE. B is taxed at 5%, which is again outside UAE. And C is a resident in UAE. If dividend is paid by A to B and B to C, then is C income taxable or exempt? So let us understand, if only B is giving dividend to C, then that income would be not fall under exempt income because B is taxed at 5%. However, if B is receiving a dividend which have been received from A, which is already taxed at 25%, then that income would be still be exempt. So this is a very welcoming provision wherein the government has tried to avoid double taxation. Secondly, free zone company is an exempt person. The tax is usually 0% if you fall under the qualified income. So they have given an exemption for these companies, a free zone and exempt person. It is deemed that they have met this 9% tax criteria. Now, is it applicable to losses on liquidation? So no, exempt income criteria wherein participation exemption do not apply to losses on liquidation. And say I have taken a investment of more than 5%, I received a dividend or profits or say capital gain, and I sold it off within 12 months. What should I do? That in that case, the year in which you sell off your investments, in that year, you offer that income as taxable income, which you have treated as exempt. So in the year in which you sold, treat the income as taxable and pay off the corporate tax at 9%. Moving on. So there are no, this is, yeah. So we have seen what is covered, what rate is covered, how to calculate we have covered. Now we will see the next part, that is calculation. So let's see this. Okay, so there are certain expenses as I told that those are non-deductible. So any losses or expenditure with regards to your exempt income or non-business income will not be allowed as deduction. Donation, fines, penalties, dividend, or taxes paid will not be allowed as a deduction. Interestingly, all over the world, 75% of the litigation is on the basis of deductible expenses. So this seems to be a smaller para in my presentation, but this is a very important aspect wherein tax authorities mostly litigate on what kind of expenses they should allow you, wherein they will be treated as business income. So anywhere they find that this expense relates to your non-business item, your personal expenses, or it relates to exempt income, then they straight away disallow it. So we have to be very careful with our documentation proving the expenses relates to your business. Then next comes the entertainment expenditure, wherein there is a wide list of expenditure treated as entertainment expenditure, such as hoteling, drink, foods, wherein you incur them for your customers or suppliers or shareholders or any other business purpose. Whatever expense you incur, only 50% would be allowed as deduction. So this is entertainment expenditure. Next is net interest expenditure. So they have capped the limit for interest expenditure here. say you are a heavily leveraged company wherein you have lots of loans and the interest expenditure is very high. But the corporate law states that whatever your income before interest and depreciation, that is EBITDA, 30% of EBITDA is only allowed as your interest deduction, not more than that. And whatever balance is there, you can carry it forward for the next 10 tax periods. So this is an issue wherein 30% of your net interest expenditure, 30% of EBITDA is only allowed. Rest of the expenditure will not be allowed and you need to carry them forward. Also, government has put up a related party interest expenditure limitation, wherein wherever you pay your interest to your related parties, then there are certain conditions which has to be met. Otherwise, that interest expenditure would not be allowed. So this is with regards to the expenditures which are not allowed. Now we have seen what is covered at what rate, how do we calculate it. Now let's see determination and payment of corporate tax. So now, as per our financials, we come to a profit wherein we make these adjustments, 7 adjustments, we come to our taxable income. Now with that taxable income, what do? We calculate tax at 9% and we deduct TDS. Right now, withholding provisions are not there. The act is there, the section is there, the rate is 0%. So technically, there won't be any withholding right now because the rate is 0%, but we may say this in future. Then we have to reduce our foreign tax credit. Whatever tax you have paid in foreign countries over the income which is taxable here, that credit you can claim. Then there are reliefs and credits. And balance, if any, you have to pay it and file the return within 9 months from the end of the financial year. Say if the financial year is ending in December, before next September, we have to file our tax return and pay our taxes. So payment of taxes, this is also very welcoming provision wherein payment of taxes is not as per quarterly, it is just one time and that too within 9 months. So we get ample amount of time to pay the tax. And there's a refund provision also, wherein if you have excess TDS credit or excess payment of tax, then you can get a refund as well. For the TDS credit, you can carry it forward. But for foreign tax credit, there is no refund and there is no carry forward. Foreign taxes, if not utilized, will lapse. Moving on, tax losses. So this is also very welcoming provisions wherein tax losses can be carried forward for indefinite period. There are some certain ineligible losses. One is pre-tax era losses. Yeah, pre-tax era losses. It means before corporate tax coming into force, if you have any losses, those losses will not be carried forward. And there are other non-taxable losses. It means any losses with regards to your non-business activity if you are individual or an exempt category losses, those losses will not be carried forward. Now, with regards to set off, once you have your losses, you will carry forward. Say I have 100 million of losses, which I carry forward to next year. And for next year, I have 100 million as an income. But I can't set off the loss of 100 million, which I have carried forward from the next year because there is a capping provision wherein they say only 75% of that year's income can be set off as losses. So you still end up paying on 25% at the rate of 9% or 0%, whatsoever it may be. But 75% of that year's income can only be set off. For that, they have put up a condition of ownership wherein the ownership needs to continue from the year in which they have incurred till the year the losses are set off, and at least 50% of the ownership should remain same. This is a very prudent provision. Otherwise, if this provision would not have been there, then there would have been, say, tax loss shopping, wherein people will incur losses, sell off the companies, other people will purchase it and set off the losses. So to avoid losses shopping, they have this provisions. Also, there are other conditions, that exception conditions, wherein if there is a similar business or whole activity is been sold off or listed entities, then the 50% criteria would not apply. Moving on, tax losses. This is also very welcoming provision, wherein say you have two different companies, company A and company B. For company A and company B to form a tax group, you need a 90% ownership. However, if you have only 75% ownership, you can transfer your losses from entity A to entity B. There are other conditions to it, where they need to have similar financial year. They need not be exempt or qualified for some persons. So even if you are only just 75% in two different entities, one losses from one entity can be transferred to your another entity. So here we have seen tax losses. Now let us see tax group. If you have a 95% holding, if there is a parent and subsidiary relation, or there is a sister parent relation, wherein you can form a tax group. So in the eyes of the law, when you form a tax group, you will be treated as one single entity. Transfer pricing provisions would not be obviously applicable between that tax group. So there are three entities in that tax group. Your intercompany transactions, transfer pricing provisions would not apply. Obviously, there are certain conditions to it. There is also a provision wherein subsidiaries at a certain point of time can join in that group, or they can leave that group as well. There are conditions with regards to losses, that pre-tax group losses will be set off against that group company, that individual company only. And the liability would be joint and several. Obviously, as this is a tax group wherein an entities no transfer pricing provisions would be applicable. Thus, free zone and exempt entities have been disregarded from tax group. They cannot form a tax group. And the important issue over here is the VAT groups and tax group are both different. They are under very different legislature. So even if you have VAT group, not necessarily that will fall under tax group. So for tax group, you have to form a tax group separately, and the conditions will apply to tax group separately. No reference has to be made to VAT group. That is a different act. This is a different act. So you cannot take any referencing or any taxability from VAT groups to your corporate tax group. Moving on, general anti-abuse rules. This is a very important aspect, wherein this has a hidden agenda. So general anti-abuse rules, or widely known as general anti-avoidance regulations. These regulations, the intention of these regulations is, say now the tax law has come up, people will obviously start planning. So what they did is they have put up this provisions wherein if there is any lack of commercial substance, or any restructuring you do, or any arrangement you do, and the main intention of that arrangement is to avoid corporate tax, then the government has power to disregard that transaction. So that is the power, and this is the purpose. Now the main thing over here is the starting date. When does it start? So for your information, general anti-abuse rules have already come into place. When the decree law was published, that was 3rd October 2022. 15 days from that, that is 18th October 2022, these GAR provisions are already into place. So for any planning, any restructuring, we need to have more vigor in those transactions. We need to have more planning, wherein we can justify the tax authorities that what we have done is and has commercial substance to it. My personal view, anything done or any restructuring done solely for corporate tax planning will not work. But there has to be a vigor or a substance to it wherein we can justify those transactions to the government. We can still plan, we can still restructure, but we have to keep these provisions into mind. Transfer pricing. Transfer pricing being very new to this region. So what I did is I tried to cover up from the basics. Multinational companies herein would know what is a transfer pricing, but I would still, for the benefit all public, I would still go in detail and tell what are the transfer pricing provisions and why it is there. So transfer pricing is any price at which company transfers their resources such as goods, service, may it be loans or intangible items to related or connected person, which is should be at arm's length. So that is called a transfer pricing. You transfer something or transfer a resource to your connected person, then it would be fall under transfer pricing. And the transfer pricing should always be at arm's length. So now why transfer pricing? So, say there is a company, one in UAE and one is BVI, it is Virgin Islands. A company in UAE will be now taxed at 9%. So say it has 100 million income. What this company will do is with the company will say, and we have incurred expenses of 90 million and will pay the tax only on 10 million over here. And the tax will be paid accordingly. Now, this 90 million will be given to a branch to in British Virgin Islands, whereas there is zero tax, and end up paying zero tax on those 90 million. So, what this company did in UAE is that effectively transferred their income to another country, by which means they have avoided paying tax in any of the countries. Thus, transfer pricing provisions are important, wherein each country protects their interest and their share of tax, wherein they see that whatever transaction you do between your connected and related person is at arm's length. You are not either under selling them or under buying it. These kind of transactions are called international transfer pricing, international transactions. There are domestic transactions as well, wherein say there are two companies in UAE. One is taxed at 9%, another one is at 0%. Say it is a free zone entity. So obviously, a taxable entity will try to push in the expenses to related person wherein they are taxed at 0%. So thus, this is called domestic transfer pricing transactions, wherein even if you are doing transactions with the entity within the country, domestic transfer pricing regulations will kick in. This has been clarified through FAQs as well. Now we understand why transfer pricing is there. Now, who are those connected and related persons? We need to understand with whom these transfer pricing regulations will apply. Say you are an individual, then from now onwards, you need to start finding your relatives or your connected person with 4G speed. I know that nowadays 5G has come up, but for tax, it is still 4G. Why? Because as per the definition, you have to go till fourth kinship, fourth degree of the kinship. It means you have to go 4 degrees above. I have found this very interesting chart wherein I will tell you. Say you are a descendant, then who will be your connected and related person wherein transfer pricing provisions would be applicable? Then that will be, you have to go 4 degree, 4G speed. So 4 degree up, 4 degree down, and 4 degree sideways. So your parents, your grandparents, your great grandparents, and your great great grandparent is covered as well. Similarly, your child, your grandchild, and your great grandchild is also covered. If you have any siblings, then your sibling would be covered, your siblings' niece would be covered, their grand niece will be covered, and great grand niece and nephew will also be covered. So sorry, the great grand nephew will not be covered because it will go till fifth degree. Only 4 degrees will be covered. And your aunt, uncle will be covered, and your first cousins will be covered. So we have to go till 4 degree only. Okay. So now start finding your relatives, start knowing them, start documenting them. Who are your relatives till fourth generation? Now now these relatives are applicable only if there is a transaction between two individuals. Now say now there is a transaction between a company and an individual. So say there is this LLC called Good LLC. A natural person who holds more than 50% or more or controls that entity, even if not 50%, even though if he controls that entity, that person will be called as a connected and related person. Now, upon that, you as an individual plus your relatives at 4G speed who controls 50% or more or have control over the entity will be treated as connected or related person. Now, the third step, you with your relatives and with other entities which you control, all put together, if you control this entity, Good LLC, then again, all these people, individual relatives put together will be determined as connected or related persons. So you see, this has a very wide definition of connected and related persons. Upon that, person and its PE or foreign PE are treated as connected related persons, partners in unincorporated partnership, person who is a trustee, owner, director, or officer, and their related persons of a company is treated as a related person. Now here the definition of control is different than what we have in IFRS. So you need to study the definition of control as well. We are hoping that in every country, the transfer pricing regulations usually have a threshold. So we are expecting a threshold for domestic and international transfer pricing as well. Now we have seen that who are your connected and related person and any transaction with them is covered under transfer pricing provisions. Now, the intention being these transactions should be at arm's length or market price. So how do you determine that what I undertake with a parent company or my related company or any other person, if I pay him a salary to my connected related person, any expenses, will it be at arm's length price or not? So just to simplify what I'm trying to say if I go in market and I want to find the price of this car, what I'll do is I'll check how much CC is there, I'll see the color, I'll see what type, fuel type, mileage. Compare this all aspects and come up that in market with this variations or this specifications, this is the price of the car and this is the market value of the car. Wherein this will be accepted by the government because this is what we get. When we go for determining a transaction between an LLC and an owner or a transfer pricing, it becomes much more complex. Say you have to understand the contractual terms of the transaction or arrangement. Then you have to understand the characteristics of transactions. You have to understand the economic circumstances. You have to understand what are the functions performed by the company and by the related or the connected person. What are the assets employed? What are the risks assumed by the company and the business strategy involved? So all these parameters has to be there. So you see, it is a very lengthy and detailed study. It has to be conducted first to understand our company. Based on that study, we have to find similar companies with respect to above all mentioned criteria, be it in Asia Pacific or all the group companies. Then on that basis, we have to study their margins. And that margin should match with our margins, say it a profit margin or cost margin. And if we are able to justify that, then only it will be acceptable to FTA. So all put together, this forms a transfer pricing report, which usually comes around 100 pages or so. So it has a very detailed kind of work we need to do for this transfer pricing transaction. Thus, we are hoping a good amount of threshold limit wherein smaller companies should be exempt from such detailed study. Transfer pricing methods have been prescribed, which is again based on OECD guidelines. The welcoming note over here is they have mentioned that you can use a combination of methods as well, apart from the prescribed methods. Any other method which is there, you can use. So, which is a welcoming provision. TP documentation. Yeah, so TP disclosure form, we are assuming TP disclosure form needs to be filed with your tax returns. You need to maintain a master file and a local file for transfer pricing documentation with your related connected person and your relatives at 4G speed, wherein a master file would have a high level overview of a group business, group allocation, uh, organization structure, R&D policy, financial arrangements, and financial and tax positions of that group as a whole. And in local file, you need to maintain more detailed information with regards to the intercompany transactions, relevant financial information for specific transaction, functional benchmarking analysis. This is not so expected to have a threshold. We are expected that small businesses would be exempted. Listed companies would not be covered under this, and intergroup transactions would not be covered. They have mentioned the time limit for submission, wherein with while filing the tax return, you don't have to give all the master and local file, but FTA can ask anytime these documentations, wherein only 30 days would be given to any company to submit these transactions. So, in all, we have seen what is covered, how it is calculated, determination of and payment of corporate tax, tax losses, tax groups, general anti-abuse rules, and transfer pricing. So we try to cover the crux of the law which has come up. Now we go about it. As you understand what kind of income would be taxable. So we have to do an impact analysis. So based on definitions such as PE, your qualified free zone entity, income sourced from UAE definitions, and also the economic substance is there or not, we have to do an impact analysis. How does it impact our company, group, or a group of companies? We can restructure and see after seeing a commercial rationale. We can do a tax optimization, but also we have to keep anti-abuse rules into place. We have to see free zone entities who will fall under free zone, and the transfer pricing provisions with regards to the free zone entities. Even though those are taxed at 0%, this transfer pricing provisions would be applicable. We have to identify our related connected persons at 4G speed. We have the OECD guidelines are already there. So we can use that as a base, and we can start reviewing our transfer pricing policies. We need to study double taxation avoidance agreement, which UAE already has in place. We need to adjust our opening balances with regards to our books, because going forward, whenever the income would be taxable, that balances, the opening balance sheets need to be adjusted properly. And OECD documentation guidelines are already there. We need to take a call, do we need to form a tax group or do we need not? And is our system IT ready? Do we have proper accounting software? Do we have proper software wherein they can identify related parties? Do we have a software which will say that this income is exempt and tax calculation would be done accordingly or not? So system readiness needs to be there. With this, everyone, I conclude my presentation. The session is now open for Q&A. Okay. There are many questions in the chat box. I'll take few of them right now. Okay. Do free zone person has to register or not? So yeah, the
Okay, now Rihanna has to go inside. Shall I even?
Okay, the free zone person has to register, even if they have qualified income or non-qualified income, they has to register, because they fall fall under the taxable income. Then the next question is, what is the limit given for management remuneration? So there is no limit prescribed as of today for giving management remuneration. We have to study the transfer pricing details wherein we will be able to justify the amount of remuneration that we are giving. We are also, unless there is certain government guidelines wherein they can give us a benchmark to it. If not, we have to do a proper TP documentation study to maintain and to justify the management remuneration fees or remuneration which we are giving. Okay, record keeping of books we need to require for how many years? For VAT, the record keeping requirements is 5, but in corporate tax, the record keeping requirements is 7 years for corporate tax. So since from the start of your financial year in which it will be taxable, from there till 7 years, you have to maintain the record. FTA may ask for that record anytime. The next question is, can we continue VAT grouping? So as I mentioned, VAT groups is different, corporate group is different. We cannot take any reference from the VAT group which we have already formed. There are different requirements to it. So VAT group needs to be ignored. For corporate tax, you need to freshly look again into all the aspects and form a corporate tax group. Just a second. Yeah. Okay, now can we get chart of accounts to be in line with corporate tax? Yeah, chart of accounts would be your books of accounts only, wherein you need to maintain all the accounting aspects of your books. Also, we can give you a sample chart of accounts wherein these balances need to be maintained. There is one more question that I am an expat salaried individual owning 3 houses in UAE that would generate 500,000 dirhams of rental annual income. Does this income come under corporate tax? So right now, this is as per our interpretation, getting a rental income does not fall under business definition. If in future the government can come up with a threshold wherein they can say up to 10 limits, up to 10 houses you can have. But as of today, getting a rental income does not fall under corporate tax. Salary does not fall under corporate tax. Thus, no tax will be applicable. Is there any threshold limit for tax audit here? How can a corporate tax loss be carried forward? Right now, there is no requirement of tax audit. So, sorry, there are two types of audits I can understand over here. One is a tax audit done by the government and a tax audit requirement from an auditor. So right now, none of the limits have been prescribed. Government can select audit anytime. There are, as I said, executive regulations or cabinet decisions are yet to be there. So right now, everything is open for them. With regards to getting books audited as a tax auditor from a chartered accountant, that has not been prescribed by the decree law. There is your normal audit needs to be done, but a specific tax audit has not been prescribed yet. Okay. Yeah. So there are certain queries which are very subjective. So such as expenses booked in branch will be allowed or not. That again depends upon the facts of the case. Okay. Okay. I'm here with handing over it to Parimal for taking this seminar forward.
Hello, everyone.
Hi, Aditya. Actually, this is Saifuddin from Avipro. There are a few more questions listed out there in the public chat. I guess that has not been addressed. Actually, I was looking at the questions and to get the answers, not from myself alone, other people also.
Yes, sir. What I'll do is, due to time constraint, we request the people to kindly mail those queries to their respective auditors. They'll address their queries in detail.
Okay, just before we conclude this webinar, I would like to hand over the opportunity to Mr. Sawant, our senior most partner, in order to provide his word of thanks or his concluding remark. Now, Mr. Sawant is a fellow chartered accountant with the Institute of Chartered Accountants in India, and he has more than 40 years of experience in the audit profession, with 21 years in a Big Four company and 16 years in the Heller and outside. He is the firm's technical director, and he is in charge of the firm's audit practice. I now hand over the mic to Mr. Sawant.
Hi, good evening, friends. This is Sudhir Sawant. On behalf of BLS, I'm very grateful to you for taking interest in our efforts and attending the seminar or webinar in large numbers. Once the rules are formed up, we will have another seminar. And if you have got any questions, you can raise those by emails to the respective auditors. We will be ready to answer them. Thank you very much for attending the seminar.